evening, everybody. Good afternoon. Welcome to the Trader Merlin Show. I know the intro is going to be a little bit weird here. I forgot to hit that live record button, but we're good. For some reason, my video still looks really weird and grainy. I don't know why that is, everybody, but we had an interesting day today, a special day. Normally, we get an FOMC announcement on a Wednesday. Well, today is Thursday, so the digestion period is going to be a little bit different here. One piece before we do get started. Want to make everyone aware of scammers and imposters. I've talked about this in the past before. There's somebody on Telegram who apparently is using my name. I don't even use Telegram, and they're spamming people, trying to get you to, to buy what I'm selling and put your money with me, and I'll make you all this crazy rate of return. Look, I'm not selling you anything on Instagram or LinkedIn or Facebook. I'm not trying to get you to buy into investment services. I will not manage your money. So please, if you see anything like that, just report the damn scammer and leave it alone. All right, let's get into the discussion for today. I have a picture here of Jerome Powell looking somewhat evil and ominous. I kind of liked it. I thought this was the Halloween theme, even though we're a little bit later than Halloween. Our guest today is going to talk to us about the latest Fed talk. And as a little precursor to this, both of us have been extremely busy today. I was teaching a crypto class all morning. Bill's been teaching a bond class all morning. So we've both got a lot going on today, but we wanted to make sure we got this show and talked about what's happening from the Fed's perspective. That said, here's my guest for DiGiorno. We've got Mr. Bill Addiss. How you doing, Bill?
Always a pleasure, Merlin. Thank you. You sound like a one-on paper hanger. You're doing a lot of things going on.
I'm always trying to do as much as I can, but yeah, today's been a wild ride with regards to teaching and presenting and all that. What's new in your world? You mentioned you were teaching all day today. What's going on? Are you teaching for a trading academy or the big firms?
Oh, no. I have to confess on my day job, which is doing training for large institutions, something's happened where the fourth quarter has just become alive. I mean, normally in the training world, after a busy summer with the new hires, we kind of fade into December. November is going to be my busiest month. I'm back out on the road for BlackRock. I was in New York last week. Next week, I'll be in Princeton and San Francisco. So in addition to the virtual business, which has kind of become a mainstay, I got to say, it's nice to have my suitcase out again and be hitting the road again. And I think there's a value to live training. So if I can get in a classroom, I honestly prefer that to the Zoom. Zoom's a necessary reality, but I really like the classroom experience. So I'm in my heaven being back in the classroom this month.
Nice. Well, if I could play the song without getting in trouble from what are they? The Google police over there. I put a little Willie Nelson on the road again.
On the road again. That's it. That's my theme song. Exactly. So good to have suitcases packed.
Nice. Cool. Well, I would love to catch up with you one day. At this point, I think you owe me about 4 or 5, maybe a half dozen beers of the way this thing's going.
I'll agree we're up to 4 beers. I've always been on the wrong side of the wager side. So when we get together, I at least owe you 4 beers. I agree. So we'll make good on it.
Sounds good. There's beers all over. I owe Big Eb a couple of beers. I owe other people. Oh boy, I tell you how it is. So let's dive into.
The good news is I owe you.
There
so
you
can
go.
Collect.
Yeah, that's good. I like that. That's the way it should be. Let's dive into what's been going on. Obviously, we have a new president not in place, but elected. Of course, we have to wait several months or a couple months before that becomes final. And there might be some new talk track about Jerome Powell's position, etc. We don't need to worry about that quite yet. Today, we got a not so surprising 25 basis point cut from Jerome Powell in the Federal Reserve. Maybe you can give us some of your thoughts on that and takeaways from today's presentation.
Yeah. What I actually would like to do is kind of go. Let's pick it up at the election if we could.
Yeah.
Because what I want to stress to the audience here is just the crazy volatility we are seeing in this market. And it really started last Friday. When we got that surprising jobs report last Friday, the long end of the market changed by yield by about 15 basis points. That's about 1% in price, where we see yields going higher, prices going down. Now, on Monday, the market took a sigh of relief and reversed that. So we went 1% the other way. But then we got the election. And the morning after, we saw a major repricing to the bond market. I mean, the all-important 10-year Treasury, which we quote all the time, is, as of last night, was at a 445. I mean, understand, we're getting to the 4.5, I think perhaps on our way to 5%. So the paradox here is that while the Fed is cutting short-term rates, I think the real action is in the long end, where long-term rates are going in exactly the opposite direction. Since the Fed cut interest rates last time, the first time, 8 weeks ago, The 10-year Treasury is up 70 basis
I
points in
know.
yield.
Huge.
70 basis points, huge. And I feel bad for people who didn't quite understand. And I've actually had two people say this to me, that they were saying that, we're waiting to refinance our mortgage because we're waiting for the Fed to start cutting rates.
Yeah.
Well, guess what? That's an apples and oranges comparison,
Mm-hmm.
because the good news is the Fed has cut rates. Now, again, today they cut another 25, but that's to short-term interest rates. That's literally just the one-day interest rate. That's the only interest rate the Fed drops, is those one-day rates, the Fed funds rate, the discount rate, and we'll talk about it if you want. But the Fed cut four different rates today, as they usually do, but all of them are overnight one-day interest rates. When you're talking about the 10-year, the 30-year mortgages, they don't correlate at all to the Fed funds. So the good news is, yeah, the Fed funds cut rates. The bad news is long-term rates are up. I mean, mortgage rates are up almost 3/4 of a point this month.
Yeah.
So those people who thought they were waiting for the Fed to help them, they got what they wanted, but they just asked for the wrong thing. They should have asked for 10-year yields to go down, not the Fed funds rate to go down, if that makes sense.
Yeah, and I think that's one of the big misconceptions is, oh, well, if they're going to drop the short end of that yield curve, that everything's going to go down, and that's not necessarily the case. And it's strange to me, maybe that strange to most, that they don't follow, because I think normally you would see that whole curve lifting and lowering together in a normal situation. And I would argue we're in a very different
I'm respectfully
market. Okay, cool.
Yeah, I'm respectfully going to disagree a little bit, because truly the factor short-term interest rates are totally different than the factors that affect long-term rates. The Fed owns that overnight interest rate. They control it. So think of it like, by the way, do you have the chart I sent with the blue and red graph? That might help.
Yeah, there you go. Bring it up.
All right. Let's get the visual aid up there. So the Fed dropped the one-day interest rate, and accordingly, the short-term rates are showing this. Now, what I'm showing you here is the blue line is the yield curve as of last night. So this was before today's rate change. And the red line was the yield curve exactly 8 weeks ago, right before the Fed dropped interest rates for the first time. So we're capturing the Fed dropping rates and seeing what's happened.
Yeah.
So in the short end of the market, the 1 month, the 2 month, and then that RPR rate, which is the repo rate, the Fed came in and dropped that by 25 basis points. And you can see where we were 8 weeks ago versus where we are today reflects that drop. But notice the further we go out, the less correlation there is, until by the time we get to the 6-month maturity. Over the last 8 weeks rather, long-term rates, as this is showing, have actually gone in the opposite direction. The yield curve is dynamic. The yield curve is constantly changing in shape and in slope. And in doing so, it's telegraphing something to us. So, the long rates, and the question, I'm going to beat your audience to the question that's coming, is, okay, if short rates are coming down because the Fed is doing it, why are long rates going up? And there's general consensus that over the last 8 weeks, there's two reasons for that. And I think they're going to continue. Number one is, last month's inflation number was surprisingly strong. We saw a real spike in inflation last month. Now, what everyone's worried about, was that a 1-month aberration, or do we still have the beginnings of a problem here? Because I have to remind everyone, the Fed started cutting rates before we actually hit our targets.
Right.
We never hit the Fed funds target rate of 2.5%. And yet here's the Fed dropping rates. And they dropped them aggressively with 50 basis points to kick it off. The market is worried that the Fed is actually going to reignite the economy, because I continue to stress we've got a boatload of cash still floating around in the economy. The M1 is still at massive levels from where we were pre-pandemic. There's a huge amount of cash in our system. And the marketplace is legitimately afraid, once again, sorry to be redundant, that inflation could be rearing its ugly head. So with the fear, I wouldn't call it the reality, with the fear of growing inflationary pressures, long rates tend to go up. The other thing that's going on is, and we've been stressing this, is the overabundance of supply coming in.
Right.
I mean, we had 10-year, 30-year auctions this week, which fortunately went well, but we have a lot of supply coming in. And again, this overabundance of unprecedented supply hitting the market, that also drives rates up. And I don't foresee either of these abating. I mean, I'll be quite honest with you. As you know from our program last month, I thought rates were more likely to go up in the long end than down. I don't think we're done. I wouldn't be surprised if we hit 5% before we hit 4%.
I gotta
on the
say,
longer rates.
I still am shocked. I think that, so we've got one of our viewers here, Big Ed. We made a wager that we wouldn't be below 4% on the 10-year, and I should have said by year end, but it was at any point between
Right.
the beginning of the year. And I was shocked to see us get down to 3.6%. That really, I was like, wow,
Yeah.
tanking.
Yeah.
Now all of a sudden it feels like my thoughts are, it's going back to where I thought it was going to be. Now I think Piper Jaffray was saying that they see it at 5% by the end of the year. Now we're at 4.32%. That'd be another 68 basis points between now and the end of the year. That's not that far away. I mean, we got 2 months. What do you think the realistic probability of that 10-year getting that high? Or is there enough, lack of demand to push it that high?
I do worry about that. Yes, I really do. And again, I stress, I worry, my fear is, and it's my worry, is that inflation number was a harbinger of things to come, not a one-off. If that inflation number was a one-off, then we'll go back to the low 4%. And I don't think we'll go back below 4%. But if inflation really does rear its head 2 months in a row, I could easily see us going back to 5% on the 10-year. Yeah.
Now, when you look at that, you're looking at the core PCE. That's what I have up here right now. We were down at 0.1, and all of a sudden we're at 0.3. I mean, that's a pretty significant jump. Now, granted, it's 1 point data, right? We'll have to wait another 3 weeks before we get the next reading. But if that next one pumps up to 0.4, 0.5, it's one of those, oh, shoot kind of moments.
Yep, here we go again. And that's the crapshoot. But I add on top of it, I'm a traditional Keynesian kind of guy. We've still got all this money floating around in the economy. And the Fed is cutting rates with a boatload of cash out there. That's just a prescription for inflation. So I'm a traditionalist, I readily admit. I mean, the Fed is trying to taper. And by the way, that's the only thing I haven't been able to find from today's meetings, because like you, I was in class all day. We're in the weird situation right now where the Fed is both easing and tapering at the same time. This has never happened before in economic history. The Fed is bringing down interest rates. This is the second meeting in a row. That's easing, obviously. But at the same time, the Fed is also tapering. The Fed up until this month has been destroying $90 billion a month, literally just destroying $90 billion a month. That's tapering.
Yep.
So at the same time the Fed is easing, the Fed is also tapering. It's kind of like polluting in your own pool, as some people say. But they're each addressing different situations. But literally, in the world of economic history, there's never been a central bank that was both easing and tapering at the same time. So we got to clean up all this cash. We got to get rid of some of this cash in the economy. That's why the Fed is still tapering.
Yeah, it's I would say a precarious position because Oliver says here, Bill, doom and gloom. Bill, he says, just kidding. It's I wouldn't say it's doom and gloom. It's just if I think what Bill is bringing up here is if we have our three lights at the intersection, the green light, the yellow light, and the red light. The information that he's just presented is like, this is a very big yellow, if not potential red flag, because it's never been done before. And it kind of says, what the hell are you doing? You're tapering. And at the same time, it's like, are you sure you know what you're doing? Now, to be fair, and again, you do teach for the Fed, so props to them. Even with these crazy, drastic, chaotic moves that left me just going, what the hell are you doing? We haven't seen an economic collapse. So we can be doom and gloom all we want, but the market is making all-time highs and ripping. So the vast majority of people, Bill, are sitting back going, I don't care if there's red flags. It's green in my account.
And I'll even prosper that, and I'll even promote that idea. Because I honestly believe, and again, like yourself, I wasn't able to catch the press conference today. I hope Powell took a victory lap. Yeah. Because I really think it is quite conceivable that the Fed has achieved that magic soft landing. I mean, think of this. Think of the cycles we've lived through since the pandemic, right? Mm-hmm. The Fed took the Fed funds rate from 3.5% down to 0. Then they brought it all the way on up to 5.5%. Now we're in the process of bringing it down. We're down to 4.5%. And throughout all of that, we never saw a recession. Right? We're now 19 months into the inverted yield curve, which normally has predicted a recession at most by 14 months. Here we are 19 months. We still don't have a recession. I think the Fed is entitled to take a victory lap here. Yeah. I really do. I'm not pessimistic. I'm optimistic. I think the Fed has achieved this without driving the economy into a recession. The fact that they're now easing, I think we've gone full cycle. They get to take a victory lap here.
Yeah, I don't know if we get. I mean, I agree with you on a lot of it, and I think, hey, they've done a hell of a job considering where we were. This market has been, just obviously a benefactor of such incredible stimulus. But I don't think we got to our targets. I still think that they didn't reach their target unemployment or inflation, and we didn't finish this. It still is potentially. Now, granted, it's been great, and of course, everyone watching right now is saying, "I don't give a crap. My 401k, my Roth, my IRAs are all looking fantastic," and you're right. I still cannot believe that you can do that much stimulus to an economy without adverse effects. And maybe a few years down the road, I'll look back when this is all said and done and be like, "Hey, I was completely wrong." But I still feel like that there's this looming disaster potential that we haven't resolved. I
thought I was the pessimist. Man.
Well, look, if we've never done
I don't
this,
disagree with you. Yeah, but at what point do we get to say this cycle is done? At what point do we get to look back and say, "Gee, they did do it"? And I do want to point out, this is a history-making day, Merlin. I don't know if you're aware, having nothing to do with the FOMC meeting. The inverted yield curve is gone.
Yes. Yep.
Look at the 1-year Treasury yield. Now, you like the 2-year. But the 2-year has been.
Let's be clear. I don't like the 2-year. The industry typically looks at the 2-year. So that's
exactly. No, I'm debating because we've even wagered on this. There's a discussion as to whether the 1 or the 2-year is the most appropriate. But at this point, it doesn't matter. Because now, as of today, the 1-year and the 2-year are now lower yielding than the 10-year.
The way it should be.
This is the first time, as of today, this is the way it should be, right? This is a normal market if such a thing exists. I mean, literally, as of today, the inverted yield curve is gone, which again leads credence to my discussion. Even the bond market now isn't predicting a recession. So doesn't Powell get to declare that victory? But yeah, today is the day. Literally this morning, I woke up and the inverted yield curve was gone for the first time in 19 months. That's significant.
That is very significant. And so here's the 10 and the 2, which is what the market looks at. So the market will typically say, "Oh, well, we were out of this in September." But here's what Bill's saying, 10 and the 1. We've screamed to the upside. We just breached above it. We're at 0.04. So I would argue that's not even uninverted. That's flat. We're flat.
Yeah, I would agree with that. We'll agree with not inverted. How's that? I'll go with flat. That's fine. But the point is that forecasting tool, which is what the yield curve is, which was forecasting a recession for 19 months that never happened, is now not predicting a recession. I think the Fed can take a victory lap.
Yeah, I'm with you. I think they can take a victory lap.
However, still scared.
I'm not scared. Right. Hey, look, I'm not scared. I'm not scared at all. I'm optimistic because honestly, I would like to see a market correction. I would like to see a recession so I could buy back into these markets at cheaper prices. I want to see big down move. What I want to see are some of these Gen Z millennial idiots that think that they're great because they made a ton of money in a bull market, get their accounts eviscerated and watch them cry back to mommy. I want to see a bear market give me 6 months to a year of a bear market so I can wipe the slate clean of all these self-proclaimed professionals in the financial markets, and I can go, "My account went up by 30%. How'd you do?" "Oh, you're bankrupt? Bye-bye, Felicia. Go say hi to mom." Sorry, I'm on a rant.
It's not just Gen Zers. Let's be honest. We all confuse brilliance with a bull market. It's not just a Gen Z issue. Be fair.
No, but there's some people that have never experienced a bear market. I mean,
exactly.
Other than the 2020 crash from the pandemic, there has not been anything remotely close to a recession or a major bear market since 2007 and 8. That's it. I mean, 15,
if you have a 20-year history. Yeah, if you have a 20-year history, it's like we've had this conversation. There's people out there who say, "Oh my God, when the Fed raised interest rates to 5.5%, that was the highest interest rates in 20 years. Oh my God, cats and dogs living together, fear and loathing. It's the highest interest rates in 20 years." But yeah, if you look at in the last 20 years, we had the Great Recession, which was 5 years of that, and we had the pandemic. And in both situations, we were intentionally managing interest rates low because of financial crises. If you do anything longer than a 20-year history, a 5.5%, 5.25% Fed's funds rate is nothing relative to rates we've seen in the past. So yeah, people who have not experienced investing with a time frame of any longer than 20 years, they have a very, I would say, distorted picture of reality. They've lived crisis to crisis, which has meant interest rates are aberrationally low, and I would make the argument has made other asset categories overvalued like equities.
Sure. Yeah, I mean, and equities are pretty, you look across the spectrum, they are pretty overvalued. And Big Ed was pointing out today, and I think a lot of people saw this, NVIDIA today is now the biggest company in the United States. Crazy.
Yeah. Yeah. Isn't it? Absolutely.
Love it. Sorry, guys. People are like shocked at my little rant on Gen Z and millennials. Now, it's funny because I had somebody send me a link to some like 16-year-old kid who's doing nothing but bragging about how much money he's make driving around a Lamborghini. He's talking about how much money he makes trading. And I'm like, I'd love to see you get wiped out. I'd love to see him get wiped out. Anyway.
Humility is a good lesson learned.
It is. Well, and longevity. I think that's one of
Yes.
my blessings is the amount of time I've been doing this. You see market corrections. And I'll be honest, some of the best periods of trading for me have been in that 2007 to 8 period and in that 2001 to 2003 period. Just downside, downside, downside. Maybe it's my bearishness that I'm hoping comes back, but our ability to make money in all markets, I think, is what's really key here.
Well, and that's what I really would like to kind of stress a little bit is focusing on that volatility that we're seeing. When we do the focus class where we do the one-day fixed income, I really have two separate audiences that I need to appeal to now, because with interest rates having come back up from those pandemic levels, we are now starting to see interest levels that are attracting attention. Bonds are once again used for income.
Yep.
They weren't during the pandemic, and so we're reestablishing that market. But the market we picked up during the pandemic that we still have is the traders, the volatility. I mean, I just, on Wednesday, the 10-year Treasury changed by 3% in price. I'm a bond guy. I talk yields. So the interest rates changed by 18 basis points. The yield on the 10-year went up 18 basis points in one day. That's a lot of volatility. Now, on a price basis, that's about a 3% drop in prices. That's some pretty good volatility for an asset that most people think of as being dull and boring.
Yeah, stable, doesn't move.
Yeah, right. Stable, doesn't move. It's the quiet money goes into bonds. Well, that's true if you're a buy and hold type of coupon clipper. But in the meantime, we're seeing an awful lot of volatility. I mean, the TLT and some of the ETFs are seeing unprecedented volume trading this market in the last week. So it's a trader's market. It's support and demand.
It's interesting you mentioned that because when you look at something like TLT, which I just had up, and I'll bring it back up, there was a question about it. I've tried to go long TLT in January, March, and July, and then late October, and you're saying wait still. I'll get out if I'm wrong. Yeah, I do think you want to wait on this one. Again, if Bill's hypothesis is right, and I echo this as well, which I think that 10-year is going to be moving up. Obviously, the TLT is not the 10-year. It's a 20 plus. But
right.
That whole yield curve is going to shift. That means that those yields for those longer-term bonds should, if current direction holds, they should be higher, which means the price of TLT will continue to drop. And, you can see it here pretty aggressively as we've had that 10-year, because that's what I'm bouncing off of, aggressively move up. TLT has fallen in value from peak to trough here over the past 36 days, almost 12%. Bonds aren't supposed to move like that. So
exactly. That's a lot of volatility for a stable asset, right? For a boring asset.
So I don't think that, I think you want to wait here before you start buying TLT because the probability, in my opinion, is higher that this will continue to drift lower because we look at things like the 10-year yield, which is this one, and that chart looks pretty dang strong right now. And I think most industry experts, including Bill, are forecasting higher long-term rates. And I think that as well.
Yeah. And not that I, just as one more other reference, but I do respect him. Even Jamie Dimon and, over at JP Morgan, he is also been very vocal talking about 5% 10-year rates as kind of the next move. So, again, consensus can be dangerous, right? But the real issue is going to be the CPI or PCE number. We got to get a better handle on, was last month's number an aberration, or do we in fact have this problem of inflation starting to rear its ugly head? That would be ugly because that means the Fed has got to stop cutting and they might have to start raising. And let's be honest, should that happen, the equity market isn't going to like seeing that. Yeah.
Margaret, I think I might have missed that discussion earlier where we were talking about, was it Margaret? There we go. Fed cuts rates today and the 10-year yield will do what? Well, remember, they're not interlocked. I think there's a belief system that they are inexplicably tied together. But no, we know that the short end is going to be pulled down, at least for the next two meetings. Obviously, right now, I believe there's a 70% probability we'll see it again in December. Maybe that continues into 2025, but that long end is rising due to totally different forces. Remember, the Fed can't control that one, so it's a demand issue, it's a supply issue, and it's forecasting higher inflation down the road issue, and I think that's part of the main reason we're seeing those go the opposite direction.
And even specifically, I would point out to Margaret, when the Fed cut those 50 basis points last meeting 8 weeks ago, so the short end of the market dropped by 50 basis points because it reacted to the Fed. But any rates out beyond a year actually traded up that day.
Mm-hmm.
So here we had on just one day, 50 basis point cut here and a 5 basis point rise here. The point I'm constantly stressing is just this dynamic nature of the yield curve, how it changes. Interest rates do not move in a linear fashion. It drives me crazy when I hear talking heads on TV say, well, interest rates were up today or interest rates were down. I just want to throw something at the TV. That's a useless comment. What interest rate? Right?
Right.
Short-term rates move different than long-term rates. Mortgage rates can move different than muni rates. I mean, to say interest rates moved up or down is just so generic as to be useless. This picture of the yield curve, if you've still got it on, is illustrating just that dynamic nature.
Yeah.
Short-term rates are in fact, it's not a theoretical discussion. Short-term rates are moving in the opposite direction as long-term rates right now.
Right. Chad said something interesting here. He says, with the new political winds, markets are expecting inflation, I believe. And I would echo that sentiment. I think you are seeing some expectations of, not just from the new administration. Obviously, we have to wait 2 months before we see a regime change. But even before that, because of actions maybe that the Fed has done and saying, we're lowering rates already. We haven't even achieved our 2% target. I think that there is some pricing in of inflation stepping back into the markets. Now, how extreme might that be? Only the future will tell there. But if you do think inflation's back, then maybe you start looking at those bond markets and figuring how you can position yourself for it. Do you think inflation's coming back?
Yeah, and part of the problem we have is, and I'm a deficit hawk, so I have to tie it back to that. It honestly, from the point of view of the deficit, it almost didn't matter who won because we're still going to have a problem no matter who. Right? Because President-elect Trump was looking to cut taxes, and Kamala Harris had entitlement programs. We were all getting money to buy houses and other things. Money which I would point out the government doesn't have, so we're just going to have to go out and borrow more. So between Trump's tax cuts proposals and Kamala's entitlement programs, either way, the deficit is still running out of control. Yeah. And that's very concerning to me. And this is a ticking time bomb. I cannot stress this strongly enough. But the reason I think the market is reacting to Trump's victory the way it is because of his emphasis on tariffs.
Tariffs, yep, absolutely.
Tariffs are a tax.
Yep.
Tariffs are a cost. So if he, in fact, is going to be an aggressive tariff instigator, we're going to see inflation rising even greater. That's just the economic reality. So I think the market is reacting to that Trump reality, and we are more worried about inflation under Trump. We were worried about them under both because neither of them are addressing the deficit.
Right.
But it works a little bit worse, unfortunately, with the Trump victory.
Yeah, especially when you do tax cuts and lowering the corporate rate from 21 to 15, that makes more corporate spending, which is a good thing from the perspective of economic growth, right? You lower that's more spending, more capex, more development, more R&D. Yep. That sounds great. But then you add in other taxes, that's more spending, which spending drives up prices, right? Demand drives up prices. Yep. Then you add in the increased cost of the goods and services, the tariffs imposed on international products. You start off with the basis of higher prices to begin with, and then you have more spending. So yeah, inflation could come back fairly quickly here. And again, I think that's why I'm bullish on the 10-year to the upside from a yield perspective, and I don't see that stopping anytime soon.
And I just want to clarify, and it's oversimplifying, but I really want to make sure your audience is comfortable with that. So just as everyone's make sure, as yields are going higher because inflation maybe is becoming more of a problem, what that means is the prices are going down. And I know it's oversimplifying for some of you, but there's an inverse relationship between prices and yields.
Yep.
When prices of bonds are going up, that means the return is going down. Well, right now, yields are going higher. That means prices are, in fact, going down. So that's why I just want to echo what you said. If you believe in this scenario, you don't want to be rushing into the TLT because with rising rates, there's further price deterioration that should be expected.
Yep. So Larry and Margaret have asked this question. I don't want to give anyone any preferential treatment here. Powell said that he won't resign. So how do you see the future between the Fed and the administration?
Yeah, it was interesting. I just have to say, this morning, President-elect Trump came out and said he wouldn't be, he would let Powell keep his job, at least through the end of his tenure, which is interesting because as we know from the last time President Trump was president, he doesn't have the authority to fire Powell. So it's nice that the president wants Powell to stay. It's up to Powell whether he stays or not. And the only question I did catch at exactly 3 o'clock when my class was on break is some journalist asked Powell, would he step down if the president asked him to? And his answer was a one-word no. And he went on to the next question.
I love it.
So Powell's not leaving voluntarily, and the president can't fire him. So we've got Powell through the end of his tenure. He was appointed by Trump to a 4-year term. He'll get to finish that out if he wants. But I will admit that the chairman of the committee really has a lot of sway, a lot of sway. And if we do replace Powell, and remember, Trump put Powell in place by firing Janet Yellen. He didn't want Yellen as his chairman of the Fed, so when he had the opportunity, he replaced Yellen with Powell. So if he were to replace Powell, I will admit the market is going to look nervously at that. We do have a lot of confidence in Powell, I have to say. He's gone through this whole economic disaster of a pandemic and seemed to have survived economically, that we didn't get the recession we were looking for. So just from on a nonpartisan basis, economically, he seems to have done a very good job. And the markets, as you know, don't like disruption.
Yeah.
So losing Powell, number one, would be a negative. Then the question is, who are they going to replace Powell with? Now, I run the risk of getting a little bit political here, but please understand, when President Trump was president, he tried to appoint 2 people to the FOMC committee who had such out of the mainstream views that Congress wouldn't even approve them. One of the candidates wanted to go back to the gold standard. Another one wanted to do something. So bottom line, and all presidents make political appointments, don't get me wrong. But the appointments to the FOMC he has tried to make in the past are not mainstream, to say the least. If we were to get a situation like that, I could see an awful lot of lack of confidence in the market.
Yeah, it certainly. Look, I think Jerome Powell has done a decent job. I mean,
Yeah.
you inherited a pretty crazy, almost impossible situation, the black swan. I'd hate to be the chairman of the Fed and inherit a black swan event like COVID. You're like, come on, man, could I just get 4 years of smooth sailing?
Hit me again. Yeah. Hit me again.
So all in all, I think he's done a good job. Look, if you look at what Trump wants to do, Trump says, I want to lower rates. I want to lower interest rates, of course, stimulate economic growth. So Powell's doing that. So at this point, I don't see any real reason for Trump to be like anti-Powell at this moment, right?
Right.
You're not going to lower him down to zero again and get negative. I just doubt that's going to happen. Now, one thing that is of interest here is now that we have a Republican president, well, not now, when we get that Republican president and he starts to do these appointments that, of course, need to have legislative approval, you control the Senate, you control the House of Representatives. So, some of those appointees from his previous term that were like off the wall, you're like, what are you talking about? No way. Now those could get pushed through pretty quickly. Does that concern you
Absolutely.
or give you optimism?
No, it scares the heck out of me. Scares the heck out of me. I mean, please understand, for anybody to say the U.S. should go back on the gold standard is such a juvenile comment in terms of not understanding the ramifications of that. It's literally embarrassing. You can't put the toothpaste back in the tube.
It's impossible.
Because, it's impossible, literally. So why even have the discussion? So to have candidates who are out there on the lecture tour talking about the return to the gold standard in the good old days is just economically naive. And the idea that that person could actually become not only a board of governor of the FOMC, but actually become the chairperson is, in my mind, absolutely frightening. Absolutely frightening.
Yeah.
I do stress, and I don't want, again, politics is dangerous territory. I don't care what the administration is, but the Federal Reserve is separate from the government for a reason, right? You don't want the same people who are responsible for your fiscal policies to be responsible for your monetary policy. You want to have this separation.
Checks
you
and
want them
balances
separate.
too, yeah.
Checks and balances, exactly. And I'll throw it out there because it's scary to me. In Turkey, when Erdogan was elected president, he got the constitution changed that the central bank now reports to the president directly. And if any of you are looking for a bad economy, go to Turkey, where inflation is running at about 16% now. And Erdogan has fired 4 heads of the central bank in the last 2 years because they won't follow policies that are consistent with his politics.
Mm-hmm.
In other words, we're trying to remove this from the political process. Of course, Trump wants interest rates to go down. What president wouldn't want interest rates to go down?
Right.
But yet that might not be the best state for the economy. We rely on the monetary people to make the tough decisions that, quite frankly, our elected officials aren't willing to make.
Yeah.
It's just that simple. Go back to Volcker, right? He intentionally drove the economy into a recession and saved the U.S. economy back in 1979. I don't know that we have that political, strength in today's world. So I am fearful of the Fed becoming too politicized.
Yeah.
We need a separate. Let's look. And I'll throw it out there. Look how have the fiscal people done? Those people who are responsible for the budget that we're talking about, how they doing?
What budget?
How are we doing on the deficit? They're doing horribly.
Yeah.
We're going to turn around and give them responsibility for monetary policy as well? Come on.
Yeah. Yeah, I agree. I mean, you're already ruining one thing. We're not going to let you ruin two things.
Exactly. We try. It's not perfect. There are politics in it, let's be honest. But we try and keep the Fed as independent as possible, and that's by design, and I think it's a good idea.
I was going to try to bring up the national deficit just so you guys can see what that might look like. But I'm not
the clock?
No, just a chart of it so we can see. It's not really working. Different site.
Well,
go ahead.
Go ahead. I'm sorry.
I was going to bring up the talk about going back on the gold standard. And let's just say hypothetically that we back our currency, the US dollar, with gold. Okay, so $1 buys you $1 worth of gold. The sheer mathematical improbability of this is impossible because there is $18 trillion worth of gold on the entire planet. That's if every nugget morsel was in your possession. You went to all the Indian dowries and you stole all their gold, and you literally bought out every single person's gold and put it in a swimming pool.
Mined it out of people's teeth. You literally take it all.
It's $18 trillion and the US dollar money supply is $40 trillion.
Right.
So you need to double all the gold in the world right now, plus add more just to back it. There's no way it could happen. It's impossible.
And you couldn't do it at a fixed price because then wouldn't have a currency market. Right. The whole idea is currencies are free floating.
Right.
We tried pegging currencies to each other and then peg it to gold. It didn't work, right? That's why we had the Bretton Woods Agreement, was to do away with that pegging. It didn't work. Currencies need to free float.
No. I was going to bring up I'm bringing up the Swiss franc here so we can see, excuse me, what happened to their currency when they unpegged from gold. So they were pegged to gold for a while. And here's the chart of it. When they decided, we're not going to do that, whammo! I mean, we dropped thousands of pips in a matter of minutes. It was insane. This
pegging is an
literally
artificial constraint.
Yes.
Yeah, a pegging is an artificial constraint. The whole reason we had hyperinflation in 1979 is that Richard Nixon and Arthur Burns, the Treasury Secretary, you might remember, tried a system of freezing prices and wages here in the U.S. in the 1970s. Mm-hmm. That was a horrible experiment. And what we found is as soon as they lifted that, prices escalated and we suddenly had inflation at 21%.
Right.
Pegging doesn't work. You can't peg the dollar to something. You can't. It's just the markets are too mature now. They need to free float.
Bill, we've got people who say that we need you on the FOMC committee.
Hardly.
Come on.
Thank you. I appreciate the compliment, but hardly.
I'll tell you what.
I admit I do find it fascinating. I love this stuff. I'm not going to lie. I absolutely love this stuff, but I looking at it from the outside.
We couldn't tell. Your passion and enthusiasm just does not come through the screen, I'm telling you.
Yeah, I know. I have to get a life.
So as we go forward here, you can't fire Powell. He can't fire Gensler, which he has said, I'm firing Gensler. He's made that very clear. He can't do that either. Right. What's the process like? So I guess a couple different questions. What's the process like for a newly sworn in president once he takes office? How does he go about appointing those board members and choosing them? And I guess the second one I wanted to ask, I'll go through that one first because I forgot my other question.
Okay. And the process of appointing the board of governors. So assuming Biden doesn't appoint one, Trump can come in right away and appoint a board of governor member. And again, this is not a shot at any one candidate. Any political candidate or president makes political appointees.
Yep.
I mean, this is where we do get some politics into the process. So on this FOMC committee that makes the rate decisions, 7 of those members are board of governor members who are political appointees. But the good news is when somebody's appointed to that committee, not for the chairman, but just to be on the committee, they serve a 14-year term. So no one president is actually stacking the deck.
Right.
So that's meant to ensure some, it's not like when Trump is going to come in, we're going to have a whole new board of governors. No, he'll have the opportunity to appoint one right away and another one next year when somebody's 14-year term is over. So that's the opportunity he has to try and inject some policy into the Fed. And every president does it. So bottom line, by next year, we'll have 2 of the 7 members are most likely to be Trump appointees. But there are also 5 other members. It's a 12-person committee. There are also 5 other members that are non-political. They're the presidents of the regional feds. Here in the U.S., we don't have one Federal Reserve. We actually have 12.
Right.
And each Federal Reserve elects a president. So 5 of those presidents on a rotating basis. So they're non-political. These are literally bankers. So you've got this group of 12, 7 of them being political appointees somewhere in their past, 5 of them being current presidents of the Fed. That's the rate setting committee. So if you're worried, as I am, I'm not going to lie, just because he hasn't introduced people that have a lot of real experience, if you're worried about the quality of people that President Trump might appoint, the good news is they're only going to be 2 of the 12.
Right.
He's not going to have the opportunity to stack the deck like any president. Truly, I'm not trying to take a shot at President Trump.
No, we get
this
it.
would be true of any incoming president.
And out of those 12 members, all 12 of those are voting members. Are there others that get to vote?
No, you're right. They are the voting members. The other 7 members who are the regional presidents that don't get to vote, they get to attend the meetings. And in fact, they're part of the dot plots. You remember how we give the projections going forward? Yep. That's for all of the regional presidents. So the 5 who are the voting members, and that's done on a rotating basis, they have a little bit more sway, but all of the Fed presidents do attend the meeting. Only 5 of them get to vote.
Okay, nice.
Yeah.
I forgot what my other question was. I had a great question in there for you.
You're all queued up.
There you go. So when you look at, obviously you know all the members of the FOMC. You're in that world. Do you see Trump trying to, because he can remove Powell as the chairman. He can't fire him, correct?
He can ask him to step down, but he can't remove him as chairman.
Wow. So under what circumstances would there be because I know you can't do it without cause, just like just like the president can't fire the chairman of the SEC. He can demote them and replace them, but he can't fire them. What does it take for Powell to just be done with his position? He has to walk away, or is it?
Yes. Wow. No, he has to walk away. He has the option to finish out his 4-year term. He has the option of walking away if he wants to. But he does not. But the president does not have the authority to actually fire him. This got rather tested, if you remember, when President Trump was first elected, because he and Powell weren't seeing eye to eye at the time. Powell was raising, and he threatened to fire fire him from that job. And it literally did go to a lot of constitutional law, and they finally did determine that he can't be fired.
Wow, man, I'd love to have that job.
Yeah, really. But then the question is, he could be not reappointed in for the next term. So if Trump does want to get rid of him, what we're basically saying is he's got to wait till his tenure is up in 2025. Then he can get rid of him.
Yeah. Well, I think he's got a lot of other things that are on his plate that are really like a thorn in his side. I would look at what Powell's doing and I would say I don't think he conflicts so much at this moment with what Trump is hoping to achieve. Rates are getting lower. Everything seems to be fine. So in theory, when Trump takes office, he's going to walk into a pretty decent situation economically. Yeah. So, I mean,
absolutely.
Yeah.
Yeah, no, absolutely. It's going to look good. No, absolutely.
When is Powell's term up?
I know. I've read it's in the first quarter of next year. But I think it's right after the inauguration. So I think we're looking at February or March, because as I remember it, when Trump came in last time, it was within a month or two we started having this same conversation of him getting rid of Powell or renominating him. So yeah, I want to say March, but I wish I could be more definitive on that. Sometime in the first quarter next year.
All right, I was just going to try to bring it up here, but yeah, it's kind of tough. Powell's term as Fed chair ends May 15th, 2026.
No, 26?
Trump not here.
Wow.
Of course, this is a
Okay.
CNBC or CBS, so who knows if this is actually true or not. But it says,
Wow.
Trump nominated Powell to lead the Fed in 2017 and was renominated by President Joe Biden in November of 2021. Jerome Powell's term ends in May 15th of 2026.
I stand corrected. I thought it was 2025.
Learn something new every day.
Another year plus. Yeah, thank you.
If it's a 4-year term, though, I'm no math expert, but 2021 taken away from 2026 is 5.
I know, and it's a 4-year term you serve as chairman.
I'm going with your number. I'm thinking CNBC screwed up here. Mainstream media is wrong, people.
I'm inclined to say I'm going to stick with 2015 until I get a better source than the NBC.
Yeah, 2025. You mean 2025? Yes, I'm with you. I'm with you. I'm going to go with your number there. All right. I mean, I could go on and on, but I want to make sure we get to wrap this up here. You are on the road teaching a lot. You're going to be doing a ton of teaching. What are you going to be doing for Trading Academy? Where can our viewers find you?
For OTA, the next focus class we have is I'm going to be the Christmas holiday present. My next fixed income focus class is December 27th. So that's when we do a full 1 day dedicated to the bond market, talking about the relationship between bonds. So the focus series, which your audience is familiar with, the one that somebody named the canary in the coal mine, somebody who had an astute knowledge of bonds by the name of Merlin came up with the title of that. Recognizing that bonds affect all other asset categories. So that class is on the 27th. Until then, I do a monthly XLT. That'll be on, I think, the 23rd of this month. And that's an hour and a half where we have a talk about these topics. But that's pretty much it going through the end of the year. So one more focus class, the monthly XLTs, and then we'll look into 2025.
Now I'm looking forward to 2025.
Yeah. Could I hit you with a totally unrelated topic to what we've been talking about, but I want to make sure I hit with your audience?
Don't put me on the spot, man. Of course, whatever you want.
It's I-bonds.
Oh, it's I-bonds.
I just want to do a quick update for your audience because, during the pandemic, you were very instrumental and you were very vocal about promoting the opportunity of those inflation-linked savings certificates, the I-bonds.
Well, now it's come back to bite me.
No, it's not going to come back to bite you. But as we knew, those I-bonds are attractive when inflation was a problem.
Yep.
It was a way of turning lemons into lemonade, right? But as we know, for the last couple months, inflation has gone down. In the last year, inflation has gone down dramatically. And as a result, the I-bond interest has gone down also. So I just want to make sure everyone's aware that starting last week, November 1st, we have a new I-bonds coupon. And that coupon is 3.11%. That is going to be the coupon for the next 6 months. That is a pretty low coupon. Mm-hmm. I mean, if you look at the Treasury yield curve, virtually any Treasury in the market, irrespective of maturity, is going to yield you more than that. Yeah. So because inflation has come down as much as it has, and we've been talking about that, the yield on the I-bonds, I would make the argument, is actually right now rather unattractive when you look at the alternatives. So I just want to flag this. Now, the actual rate should have been much lower. Just to remind your folks, when they set the I-bonds coupon, the first function is what is the inflation. But then Janet Yellen, or whoever the Treasury Secretary is, they have the opportunity to juice up the yield even above that. And that's exactly what Janet Yellen did again this period. If we did it just based on inflation, the actual rate should have been closer to 2%. But Janet, like I know her, she decided to juice up the yield by another 120 basis points. So we got a gift from Janet Yellen of almost an extra 1.25% on the I-bonds. So the total between the floating rate component and her juicing it up is that 3.11%. That'll be the yield. But it's not a very attractive yield. No. I have to be honest with you. It was a great while it lasted, but like other trades, the market changes. Markets now change. Yeah. So you might think even about liquidating your I-bonds. I-bonds are technically a 30-year investment. They're a 30-year certificate, but you can redeem them. So if you bought an I-bond and you want to get out in the first year, you can't. You're locked out.
Right.
So there's no liquidity. You're stuck with it. But after a year, you can redeem your I-bonds between years 1 and 5, and you can turn it back to the Treasury, and you only pay a 3-month interest penalty, the most recent 3 months, which would be the lowest.
Right.
And then you can get your money back. And if you own it for longer than 5 years, you could redeem it without any penalty at all after 5 years. So I encourage people from the very beginning, don't think of this as a 30-year investment.
Right.
Think of this as a 5-year investment that's renewable, if you so choose to.
Yeah.
But with interest rates down at 3.11, I think it's fair to say this was a great opportunity when it lasted, but the opportunity's gone now.
Yeah. Well, and to be fair, it may come back, but we don't know, right? At this point, if inflation does start to rear its ugly head, but you're going to be locked in for the next 6 months at 3.11, so.
Right.
There you go.
Next for the next year.
The
next 6 months at 3.11, but the next year, if you come in as a new buyer, you can't liquidate it.
Right.
So you're right, though, Marlon, and it's important to point out, if you believe that inflation is going to start rearing its ugly head, that last month wasn't an aberration, then maybe you shouldn't be quick to redeem your I bonds. Give it another, let's see what more inflation numbers come out.
Well, we've got a few of the viewers saying that they dumped their I bonds. One in particular moved it into an asset class you're not a fan of. She dumped her I bonds and bought some Bitcoin. Nice move out there, Lori.
Nice move. Whoever it was, nice move.
Yeah, pretty good.
No, I, as you know, I don't trade crypto, but I do own crypto, so I'm very pleased with what's happened there.
Yeah, Bitcoin's been a fun one, and I think we're at the very beginning of something much bigger, so I'm excited about that.
Yeah.
All right.
I'm enjoying that as well.
Nice. Guys, if you want to find out more information, you can go to aftraining.co. That's his website out there, and there's his book sets on that one, which is a great book set. You can find that under the shop. He's got all kinds of information and videos on there as well. If you want to see him in action at Trading Academy, just contact tradingacademy.com and say, I'd like to know more about the bonds class with Bill Addiss, and we'll get you in that one and learn even more on a day-to-day basis, because there's always a wealth of information with regards to bonds.
Thank you. I enjoy working with you guys. So anything I can do to help, I look forward to it. You guys are a fun group.
I
spent 8 hours today with a major investment bank, and they weren't half as much fun as you have been today.
Life's too short. You got to have fun along the way.
Yeah, absolutely.
All right. Hey, Bill, thank you very much. I appreciate it. Hopefully we can get a chance to connect in IRL, in real life soon. So but appreciate you coming on. All right.
Merlin, it's always a pleasure. Happy holidays to everyone if I don't have a chance to talk to you, or I'll see you at the XLT class.
Sounds good.
Be well, all. Thanks, Merlin.
Thank you. Take care. Guys,
Cheers.
That was Bill Addiss giving you some insights into the bond markets and just what the interest rate statements that happened today. Interesting stuff, I think it's all very important and drives our markets going forward. Whether it's bullish or bearish doesn't really matter, in my opinion. Hopefully there's some opportunity for that in your pocket. And Bill, obviously one of the more knowledgeable people I've ever met with regards to bonds, comes on here and just shares his insights. So interesting stuff today. Hope you enjoyed that. What time is it? Oh my goodness, 54 after. I'm not even going to do a big market thing today. I will real quickly run through our top 7 here. Obviously, we had some bullishness going on for NASDAQ and technology. NASDAQ broke to all-time highs thanks to NVIDIA. When we look at the Magnificent 7 today, I don't know why my screen decides not to show all the data there, but you're looking at least 1% gains for pretty much everything in that Magnificent 7. Your worst performer was Microsoft, up 1.25%. Your best, Meta, 3.44%. But NVIDIA, where'd my NVIDIA go? No wonder NVIDIA's not on here. What's going on? Oh, there's NVIDIA. 2.25% up for NVIDIA, and all-time highs yet again. We talked about that price pattern. Higher lows, higher highs, ascending triangle breakout looks good to me. Keep on moving there. So that was a piece that vaulted NVIDIA to the largest market cap in the world. You can see right here, if we go by market cap, NVIDIA is now $3.65 trillion market cap. Apple is a weak $3.43 trillion. We have three companies that are above that $3 trillion market cap, but a couple in the $2 trillion. And we'll see if others decide to join in that party here soon, or if Bitcoin can actually break the $2 trillion market cap. It's getting there rather quickly. So market-wise, pretty darn good day. We did have a pullback in that dollar index. I think that was kind of to be expected with such a giant move. The question is, does this trend continue on up here over the coming months? I don't know. We'll have to wait and see. You had a big pullback, a pullback today in the Russell 2000, which of course was up 5+% yesterday. Small pullback, but I would argue this is a shooting star formation. It's after an impulse move. You look at the volume on this one from yesterday. That's a climactic volume spike compared to what we normally see. Today, small little shooting star formation. If you guys are looking for a downside opportunity tomorrow, I think you're looking at a break down below 2,386 on the futures for the Russell 2000. Your 10-year yields did come back just a little bit. We talked about that, 4.5%. Came right up to it, kissed 4.5, and now a little bit of a reprieve, but the trend is still up. So I'm a big fan of going with those trends. Bitcoin broke another all-time high today, still going. It's up 0.4% right now at 77,180. I love it. S&P all-time highs yet again. And in my mind, you're getting extended here. We did come back down to this low point right around 5,724, which of course was the logical stopping point for this. Screamed to the upside, all-time highs yet again. I mean, things look so good right now across the board. At some point, I just feel like the doom side has to step up. But right now, it looks like greed across the board. You had a nice move up in gold today as well, but I don't see any really strong demand level that should have bounced off of. I thought we'd actually get lower to 2006, 620. And then your biggest victor, NASDAQ. I'll get rid of the yellow box because we've broken out of that one and moved to the upside. But that's your markets for today. Tomorrow, of course, is Friday. So let me go into your economic calendar and talk about what's cooking for Friday. We will do a show tomorrow, of course. Your economic calendar doesn't have a lot of big stuff. You've got University of Michigan consumer sentiment, you have mortgage delinquencies, and a few other pieces there. But all in all, I think tomorrow is going to be a digesting kind of day where the market says, what a week. What has happened here? All this, you had major interest rates, you've got presidential elections and speculation, you've got breakouts in crypto. I mean, all-time highs for the indexes. It's just euphoria. S&P 6,000, I saw that. We got to go back and look at the forecast for the year. There were a few that had over 6,000, and we are over 6,000 right now on the S&P 500. Hallelujah, hallelujah. All right, everybody. Ooh, no watch today. All right, that's going to do it for me. I'm going to wrap up before a 1-hour show. I didn't think I'd make it that far, so thank you guys so much. Hope you enjoyed that program with Bill Addiss. He's always got some great insights to talk about these markets, so hopefully you enjoyed that, learned a little bit about bond markets along the way, and dealt with my rants along the way as well. So you guys have anything you want me to discuss on tomorrow's show? JB. So one quick comment here. JB, who I guess listens to the show, got upset that I didn't respond directly to emails. I get a lot of emails, JB. Unfortunately, I didn't respond to you yet. I'll reach out because I can tell you're frustrated with that one, but I'll email you and get you some feedback on the things you brought up with me. But yes, hope you guys enjoyed today's show. Email me at tradermerlin@gmail.com for topics and discussions, and I will see you tomorrow. Take care.